program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.
Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us again here at AusBiz. Let's get across those market movements overnight. Global stocks rising. European gains in healthcare and luxury stocks offsetting weakness in banks and energy. On Wall Street, the Nasdaq led the gains as investors bought mega cap tech stocks, despite the potential of a US government shutdown and hawkish remarks from Federal Reserve officials. AI chip leader Nvidia rose along with Microsoft. Electronic Arts shares rallied after the game publisher agreed to a private equity takeover deal worth $55 billion, with the buyers made up of the Saudi Arabia's public investment fund, Jared Kushner's Affinity Partners, and private equity firm Silver Lake. Apple oven set a fresh record high, with Morgan Stanley raising the target price on the stock. And after US President Donald Trump promoted the health benefits of hemp-derived cannabidiol, US-listed shares of cannabis-related companies surged. Cruise operator Carnival raised its annual profit forecast on strong demand and higher ticket prices for its cruise vacations. And in Europe, Lufthansa will cut 4,000 administrative jobs by 2030 and set higher profitability targets as the German airline seeks to boost efficiencies. On the geopolitical front, Israeli Prime Minister Benjamin Netanyahu has backed a US-sponsored Gaza peace proposal to end the war in the Palestinian enclave. The 20-point plan calls for a ceasefire, an exchange of hostages held by Hamas for Palestinian prisoners held by Israel, a staged Israeli withdrawal from Gaza, and Hamas disarmament. Meanwhile, in the US, Republicans and Democrats have failed to make little progress to avoid a government shutdown. Vice President J.D. Vance has said a shutdown is likely if Congress does not extend government funding beyond a Tuesday midnight deadline. And in the latest Fed speak, Cleveland President Beth Hammack said, "I continue to see that we have pressure in inflation, both in the headline, in the core, and particularly where I'm worried about it is I'm seeing it in services. My forecast is that we're going to remain above target for probably the next 1 or 2 years and not really getting back to our objective of 2%. Well, the US 2-year Treasury yield is around 3.65%. The 10-year fell slightly to 4.13%. Australian 3-year government bond yields at around 3.56%, with markets pricing in no chance that the RBA will cut the cash rate at today's meeting. US dollar index down slightly on the day. The Aussie has risen to 65.8 US cents. On the commodity front, oil prices have fallen sharply as OPEC Plus plans for another increase to oil output in November, and the resumption of oil exports by Iraq's Kurdistan raising the global supply outlook. Brent crude futures down 3% to $68 a barrel. Copper's up close to 3%, while iron ore little changed at $103 a tonne. And gold hitting another record as investors flock to the safe haven asset on fears of a potential US government shutdown. Spot gold trading around $3,830 an ounce. And Bitcoin has risen to above 114,000 US dollars. Well, let's now turn to the US market with a focus on fixed income. We're joined by Karen Manna, Investment Director at Federated Hermes in Pittsburgh. Karen, terrific to have you on AusBiz. Thanks so much for joining us for the first time. Let's take a look at the broader macro outlook in the US at the moment, obviously with expectations of further rate cuts to come. Can I first, though, turn to the most immediate issues in terms of the likelihood of a government shutdown? How do you see this playing out, and what's the reaction been on the bond market?
Good morning, and thank you so much for having me on. It's my pleasure to join you and to speak about U.S. fixed income markets. So here we are again. I guess we can say the U.S. has become fairly accustomed to these potential government shutdowns. But in the words of the administration and particularly J.D. Vance, it seems to be a foregone conclusion at this point in time that our government will shut down. So let's cover what that means. Importantly, the U.S. Treasury market will remain open for business. There will be no problems with coupon payments, with principal payments. If we had any auctions scheduled for the weeks, those will go on as planned. However, some of the key services that we anticipate this week, notably the Bureau of Labor Statistics, are not deemed as essential. So that group will close. For the US market, this means that we will not have the very important labor data release that we usually expect the first Friday of every month. So that one could be delayed until a few days after the government reopens. So very critical steps there now. Also important to note that this does not register anywhere near to a sovereign default from the United States. That would only occur if we exceeded the debt ceiling. So we had a decision on that in the spring, which was very welcomed. But this time, while it's perhaps not desirable, not as dire of a consequence, particularly as the US Treasury will remain open and functioning. In terms of Treasury rates, though, what we've seen historically during these government closures or shutdowns is that yields tend to fall. But this time around, we could perhaps be in slightly different circumstances, notably inflation, as Beth Hammack said in her remarks today, is higher, particularly higher than it was during prior government shutdowns. And as we are seeing this level of government discord, but again, without that debt ceiling problem. So time will tell. It will be interesting to see if yields really move down on this news or if they trend more on the macroeconomic data.
So Karen, clearly the market very much focused on the prospect of further rate cuts to come with expectations of another cut at the next meeting. How has that been priced in at the moment?
Excellent question. It's been very, very interesting. The markets going into the FOMC meeting going on 2 weeks ago really assumed a fairly clear, straightforward, simple path of rate cuts. And then with the Fed dot plot that emerged, the Fed's views on the economy being even more robust than it was in our last look in June, the markets have taken a little bit of a pause here. So I describe this as being less dovish, not really more hawkish, but really we've increased in yields since that meeting in September. We also think that one of the drivers of that, how investors are characterizing their approach to what the Fed will do going forward, is that the market was in a very crowded steepener trade. That's when mutual funds and other investors will opt to overweight the short end and underweight the long end to express that conviction. With the Fed delivering the cuts and looking as if we will have at least 2 more eases, it seemed that many investors may have taken off that positioning in favor of booking some profits and squaring away.
So Karen, what are your expectation as we enter the fourth quarter there in the US? You point out perhaps confidence is high, but not necessarily reflecting those odds then. What are you watchful for in the fourth quarter?
Well, we're going to watch a number of things. We're on the precipice of another earnings cycle. We've come into this with earnings expectations increasing across many sectors, which is highly unusual going into the fourth quarter. This is usually a time of the year where most of the expectations are pretty well baked into the cake, and analysts can take almost a quarter off before they deal with forecasting anew for the coming year. But now, with companies feeling perhaps stronger, better about the information flow, and better able to review and forecast cash flows, we see some certainty coming back into the market after so much uncertainty earlier in the year. Focusing on the fixed income market, the strength of these companies has definitely been revealed in the price of the corporate bond market. Both investment grade and high yield are trading near multi-decade lows. In investment grade corporate bonds, which are akin to many of the names in the S&P 500, we're seeing spreads that are in the low 70s. And in high yield, most of the index is trading under 275, if not 250 basis points in spread. Spread meaning the level that we measure the rate of return or the coupon or yield relative to the prevailing risk-free rate or the US Treasury. So very expensive times in that corporate bond market. But for treasuries, we think the difficulty is going to come in perhaps the fourth quarter as we learn more about the new Fed chair, if that's announced, as we learn more about the Fed governors. To what extent does the U.S. Federal Reserve remain independent? That is going to drive the curve, because the Federal Reserve, through the Open Market Committee, only directly controls the overnight rate. The extent to which they influence the remainder of the curve is really up to the bond market. The bond market would seek to price in risks, but also any suggestion that the Fed is not cutting according to policy or macroeconomic theory. So what we could see happen is, if the economy continues to be relatively strong, but the Fed pursues a fairly aggressive rate path, the longer end of the curve, particularly the 10-year bond, could stay where it is or even go slightly higher.
So Karen, almost out of time, to sum it up then, do you see those US yields remaining attractive relative to other markets?
I do. With all that said, the US is still the broadest, largest, most liquid market in the world. While spreads, particularly investment-grade corporate bonds and high yield, may not continue to tighten, we still are at attractive levels now where investors can go back to clipping coupons and have a fairly certain idea of the return that they can expect going forward.
Karen, thanks so much for joining us from Federated Hermes.
Thank you.
Let's return to our local market just ahead of the open then. We are expecting a positive start. Let's get to SPI futures up around 1/5%. We're going to get right across that in just a moment. Stay with us.
This program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.